The dividend income blueprint, the tax efficiency. It's not what you make, it's what you keep, which is important. Hey everyone, I'm Doug the Retirement Guy, back again with another series of our Building a Monthly Paycheck Portfolio for Retirement. This is what makes it so critical. We've talked to you about how to build the portfolio originally to build a monthly income. And now we're going to continue our series on how to take that dividend income, the blueprint that we laid out, and make it tax efficient. Because I think this is one of the biggest areas that a lot of retirees miss or overestimate in one area or too much in another area. It just basically gets down to the simple answer that I tell you. It's not what you make, it's what you keep, which is the important part of it. So if you're paying too much in taxes, or if you are putting them just simply in the wrong account, you're not keeping as much money as you possibly can. And we're going to give it all to you today. So before we get started, we have to do the investment disclaimer and the risk warning that this video is not for financial advice. This channel is purely based on my own thoughts as I navigate my personal investment journey. Please always do your own research before investing in any single stock ETF. I am not a licensed financial advisor. If you need financial help, always contact a financial advisor, as I am not liable for any investment decisions that you have to make based on this information going forward. Let's get into the breakdown. So the efficiency gap, this is a unique thing here I did, is if you had $100,000 in two portfolios and they both generated 5%, you would think you would get the same answer out of it. Well, investor A, who uses a standard brokerage account, invests that $100,000 into it, gets a 5% yield. He's going to have a net income of $3,760 because he has $1,240 of taxes that are due from that 5% that he collected. Now, investor B, using the strategic blueprint that we'll talk about here, has that same $100,000 invested, gets a 5% yield, but he's only getting a tax drain of $150. So that means he's taking home $4,850. Now, this is all hypothetical, okay, but it just shows the big difference by one simple thing: putting in a standard brokerage account or using a tax optimized system. So there's three pillars of a dividend: taxes. Now, this is not something I created. This is the true hardcore facts of what's out there. There's actually three categories or three pillars that are norm. Qualified is the gold standard. These are qualified dividends. They are the taxed at long-term capital gain rates. This is where you want to put 90% of your portfolio is into qualified dividend income funds. 0%, 15%, and 20% is the 2026 tax rates. Now, there's a lot of funds out there that use ordinary income, which is going to tax you at 22 to 37%, depending on your tax bracket. Taxed at the income bracket that you fall into, which includes your wages, your bond interest, and your option income. Very similar to what happens with JEPI. If you don't have it in the right account, you're in ordinary income funds. And then a third one that you hear a lot on the channel, and we talk a lot, especially in some of those weeklies and some monthlies use it, is the return of capital. And this is deferring your taxes down the road. It's not taxed immediately. It lowers your cost basis, and you pay the tax only when you sell that asset. So it makes some very hard judgment things to go along. This is why you hear me say on every video, always talk to a financial advisor or talk to a tax professional, because this can get really tentacles and get real deep into it. So we're going to try to give you as much as we possibly can. So as I said over on the side, it's the keep the gap. If you're getting ordinary taxes at 37% or you're getting qualified taxes, there's a big difference between the two on a $10,000 dividend income. So you heard me say about JEPI, and I call you the JEPI warning, and then return of capital. JEPI issues ordinary income. It's taxed at rates up to 37%. So if you have this in a standard brokerage account, you're just asking for normal income. It's like you're getting a paycheck that you don't have to do the work on, but you're going to pay taxes just like regular income. So JEPI should always be put into a brokerage or an IRA or a 401k retirement type package. So you're earning income by the tax purposes. Now, the other one that we use is the return of capital that you hear a lot of. And I'm breaking this down a little bit. Now, I will tell you up front, I've done a video onto it. I'll probably re-release it because of 2026, any changes that were made. But you can definitely look in our past history and you'll see that the video that we've done on this one is very, very good. And that comes from you, the viewers. You've all commented very strongly on that one. It's a very good video. And we broke it down what return of capital really is. But basically, the basic version is this. You get paid. So you have no tax bill as of today. It lowers. So when they say it's a return of capital, they'll give you a percentage of what the return of capital is. And that's estimated. They won't do it until the end of the year. But basically, it then lowers your purchasing price. So simplest thing I always say, if you bought a stock for $100 and it paid $20 in dividends, it would say it was 100% ROC, return of capital. It means your cost for those funds would be down from $100 down to $80. So it's basically they're saying they're giving you your money back. And it's not saying your value changed. It's just the way accounting works that you lowered your cost. So years later, down the road, when you basically are paying capital gains tax, you're going to, when you sell the product, most of the time you're going to hold it long enough to be classified as long-term capital gains, which is going to be that 0, that 15, or that 20% category. And that's when you're going to pay for it. So this is how it works, and that's why ROC is a big tax advantage, is that it continuously reduces your purchase price. Now there's another thing to throw in there, and I'm going to say it's Section 1256 Advantage. I'm going to keep using JEPI because this is one that's very critical, but I can use the same thing as JEPQ and XYLD. I can use all those funds for you because they pay out ordinary income. You're paying 100% ordinary income on those funds. So you got to make sure you have them in the right retirement funds. Now, tax efficiency choices. You hear about this one, QQQI and SPYI. The tax treatment that they use, they always say is Section 1256 Advantage. And a lot of people ask, what is that? Well, it's really the rule, that 60-40 rule, which is 60% of those funds are classified immediately as long-term, and 40% of them are called short-term. So long-term, again, gets you into those long-term capital gain charges to reduce your tax burden. So that's why I've always said if you're a QQI person or a SPYI person and you put that in your brokerage account, you're perfectly fine because it fits well into with the Section 1256. So they don't have to be into a retirement package like JEPI or JEPQ would be, okay? So what we're really coming back to is we're trying to help you with the tax loss harvesting. We want to make sure you're putting the proper piece in the right spot. Something I've used all of my years of working and management and so on. I always said you got to get the right people on the bus. You got to get the right people in the right seat on the bus. And this is what we're talking about here. You need to put the right fund into the right into your right brokerage account or into a retirement brokerage account. Is you make sure they're getting on the right bus, and then you can put them in the right seat. So here's a big thing too, and we're not talking all taxes this video, but 2026, the tax thresholds. So if you're single and filing status is single and you have basically, you pay zero tax on if your income is $49,450 or less, okay? And then if you're a married couple filing jointly, it actually goes to $98,900, so basically doubling that. And you're paying no tax on the first, basically, I'm going to use it 50,000, just hair under 50,000 and a hair under 100,000. Now you also have to remember the standard deduction for a single person is $15,000, which means now you've moved to a $64,000 income potential before you have to pay taxes. Same thing on a married couple who gets $30,000 worth of deductions. You're now effectively getting $129,000 of gross income that is tax-free. Okay, so these are all critical pieces of the tax part that you have to remember and know about. So when we sit down and say, hey, what am I going to do? We're talking about taxes. Well, if you remember what we talked about was the 3-layer dividend system. I think in one video I called it the paycheck system that we've had before. And the first one is going to be your growth engine. This is going to be part of your portfolio, that it's expansion. This is going to be doing things that will cover inflation on the end of your fund. So the broad index exposure to VOO, VTI, QQQ style of investments is where you're going to put some of that money to ensure your portfolio outpaces inflation over a long period of time. Now, number 2 is going to be the dividend stability. This is going to smooth out the ride. This is going to give you the quality dividend ETF, like a Charles Schwab SCHD or a DGRO style fund, providing that compounding growth by reducing the volatility. And number 3, which is the big one, is the income layer. This is the cash flow. This is the covered call and option income ETFs, like JEPI, JEPQ style funds, to generate income without forcing you to sell any of your shares. Now, I've always said the biggest mistake people make is they immediately jump to number 3. They go to the income layer, and they want to create income today, but it weakens your future. So what we get into is number 1 is your growth engine. Okay, so the blueprint we're talking about this is where you get into section 1, 2, and 3, the growth engine. And what I always suggest people, and these are just suggestions that are out here, these are just things to show you from the examples that we use in the video to give you an idea where you would be putting money at and the reason why you're putting money in. So our first one would be the Vanguard S&P 500 ETF, which is VOO. This one's designed for growth with a small little yield. And look at the performance over the period of time. So, 1 year, you're at 15.77% total return. Remember, we always look at total returns because the growth numbers, yield numbers don't mean everything. It's all about total return. And then when you look at something since inception, these things are over 10 years old, as you can see, since inception averages about 14.63% per year. Now the Invesco QQQ series, again, another one. This one goes into the NASDAQ 100 side, and 17.43% growth, 0.45 on the yield. Another one of these funds that's been out there for a long, long time, 18% over 1 year, 11% average over since inception, 20% over a 10-year run. So they're very, very strong funds, and this is why we say these are your growth funds. You're putting them into the growth segment of your portfolio, okay, and working accordingly. The second one we talk about is that dividend, the stability leg of it. Now, this one is the goal is to grow your dividends and keep stability for long-term income. So you're not going to get big growth off of these, but you're going to start adding a little bit more yield to it. And the first one we look at is Charles Schwab, SCHD. You see a 9.59% in growth, 3.44% in yield. All the stuff I'm showing you is long term, over 10 years. And you can see 1 year, 13.84%, 10-year average, 13.16%, since inception, 13% return. So that's your growth and income together combined to give you that stability. And then the iShares DRGO, 14% growth, 2% yield. Again, 16.74% over 1 year, 12.23% since inception. So you can see, looks good in 1 year. Over the long haul, both of these two are fairly equal to each other. And then number three, we get into it, and that becomes your income layer. And this is where everybody loves to have fun because this means this is what you're getting your money in. But there's a reason for every step of these, as we'll talk shortly here. So the different funds, JEPI, JEPQ, XYLD, SPYI, QQQI, we can go on and on and on. There's a lot of funds. I cover I've pretty much covered every one of these on an individual video, plus many, many others. So I'm not trying to put it to you that there's one particular fund you need to buy or do this or do that. But these funds all operate accordingly because there's so many of them to talk about. The Goldman Sachs has a couple of really good ones in the GPIQ. But all of these do things differently. But the idea of this is to give you a total return and try to find out how much of it is yield and how much of it is growth to give you a total return on how much money you're going to generate in an income side of it. This is why everyone always jumps on this one and they pick out their favorite funds and how much money am I making? But you got to build the foundation and the building blocks accordingly. So what we're really creating here with this blueprint is that monthly income machine. Everything I've talked to you so far is showing you monthly incomes. And the reason for that is there are funds out there that pay weekly, and there are funds out there that pay monthly, and there's quarterly, and then there's semi-annually, and then annually, which is one payment a year. But what we want is that we get 12 paychecks a year. So we have that consistency for cash flow, which can really help in a lot of different ways. We need cash flow off across the board. So you get a check in January, February, March, April, all the way through. And I just show you two different funds up here on the board just to show you that you get dividend yields, 1.4% paying out monthly. And there's a reason for each one of them. So the blueprint, the three blueprints for 2026, and I'll explain to you this. It all depends on where you're at in life. Okay, if you're in your 20s or your 30s, maybe even your 40s, and you're just starting to sit down and say, I want to plan for retirement. I want to start putting money away. I don't know what I want to, where I want to be or what I want to do. You're into the aggressive growth side. And you can see now why I said the blueprint works accordingly and why you got to work on your tax side of things. In the aggressive growth side of it, this would be your 20s, your 30s, and even possibly your 40s. You want 5% in income because you don't need the income. You want to build your foundation. You want to build your pot of gold. And you want 10% into stability, and 80% of your funds should be in heavy, heavy growth, which is going to be that VOO style application. So when we get into what we call a transition phase, and that's the balance core, this is when you're sitting there, maybe in your early 50s, in your whole 50s to maybe up to 60, depends on when you're going to retire. This is when you start changing your portfolio over to getting 50% income, 15% stability, and you're pulling away that 35% of your fund is getting towards growth. Now, the reason for this is you're already starting to plan and build income side of your portfolio, because that takes a little bit of time to develop to get the proper cash flow coming in and switching things around. And you may have to make some adjustments with that. And then if you're entering saying my retirement phase, I'm ready to go. I'm ready to go into retirement. Let's, turn our notice in and we're retiring. Then you're going to have, and you can see how we made that transition to 75% of your portfolio is income, 15% stability, and 10% into growth. So no matter what you do, you'll always have a growth fund until you basically get to the point where I'm maxed out. I am spending everything income and I still got stuff left over. Then you can start making changes. But these are the three areas. We have aggressive growth, balanced core, and the income focused, all based off of what age you are. And where do you put these things? Well, simple. The farther out you go, you're going to be into the 401ks. Even in balanced core, I'd say 401ks and IRAs. And then when you get into retirement, you're going to probably split into two separate funds. And that would be your retirement fund, and then you're probably going to put some money into just a regular brokerage account. So our final blueprint, what we talk about, you see how the taxes work. You want to look at different funds that have those tax advantages to take care of your tax burden. It'd be nice to be able to collect $120,000 in income and not have to worry about one single tax. That's the big thing that happened with the big, beautiful bill. Not getting political, but that was a huge change that helped a lot of retirees. So the Elite 8 checklist, like I told you, the VOO is for that growth engine. The SCHD is that anchor in that stability. It helps you make out the smoother ride. QQQI and SPYI are tax efficiency for income side of it. So there's a lot of pieces of this thing that really helps you get through the entire blueprint of it. Guys, I hope this helps to the series. I hope this helped out. If you like it, hit that like button. It helps the channel the most, gets the algorithm rolling with us. And let me know your comments. If you want us to go deeper and more involved into this, we can do a complete series on all of these, tie it all to one big video for you to help you out in your retirement planning. I hope this helped. And I'm Doug the Retirement Guy, and we'll catch you next.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments